ONEOK is a major company in the North American energy sector. It operates as a midstream service provider. This means it owns and runs the critical infrastructure that connects energy producers to consumers. Its vast network includes pipelines, processing plant storage facilities. For many investors, ONEOK is a name they associate with income. The company has a long history of paying dividends to its shareholders. This makes the stock a point of interest for those seeking regular cash flow from their investments. The stock's performance is closely tied to the health of the energy market and the company's ability to generate consistent cash. The main attraction for many is ONEOK's substantial dividend. The company pays an annual dividend of $4.12 per share. This translates to a dividend yield of approximately 6.08%. A yield this high can be very appealing in an environment where investors are searching for returns. The company distributes these payments to its shareholders on a quarterly basis. The most recent dividend was a payment of $1.03 per share, which was distributed on November 14, 2025. Understanding this dividend is the first step for anyone considering an investment in ONEOK. It represents a significant portion of the total return an investor might expect from owning the stock. Why should an investor care about this company? Beyond the dividend, ONEOK represents a play on the long-term energy needs of the United States. Its assets are essential for transporting natural gas liquids, crude oil. The company has also been active in growing its business through large acquisitions. These strategic moves are designed to increase its earnings power and secure its market position for years to come. Therefore, looking at ONEOK involves balancing its attractive income stream with its growth strategy and the inherent risks of the energy industry. The story of this stock is one of yield, growth, and strategic navigation. This essay will explore the key aspects of ONEOK stock in a clear and simple way. Dividend, detail, safety history, recent earnings performance, business model, recent acquisitions, analysts on Wall Street, potential risks involved. This complete picture will help provide a balanced view for anyone trying to understand ONEOK and its place in an investment portfolio. The goal is to present the facts in a straightforward manner. The dividend is a central part of the investment case for ONEOK. The company pays an annual dividend of $4.12 per share. That results in a dividend yield of 6.08%. This level of yield is significantly higher than the broader market or many other large-cap stocks. For income-focused investors, this is a powerful incentive. The company has increased its dividend for 3 consecutive years. That track record suggests financial stability and a priority on returning capital to owners. These regular payments provide a steady stream of income. To understand sustainability, look at the payout ratio. ONEOK's payout ratio is 75.29%. In simple terms, that's about 75 cents of every dollar earned paid as dividends. The remaining 25 cents is retained by the company. That retained cash can be used for paying down debt. It can be used for funding new projects or for making acquisitions. A high payout ratio shows a strong commitment to the dividend. However, it also means less of a safety cushion if earnings decline unexpectedly. The quarterly payment schedule provides a regular cadence of returns for shareholders. The most recent dividend was $1.03 per share. It was paid on November 14, 2025. A company's ability to pay dividends and grow over time depends on its financial performance. ONEOK's recent earnings report for the third quarter of 2024 provided a mixed but ultimately positive picture. The company reported a net income of $693 million for the quarter. This translated into earnings of $1.18 per diluted share. That figure fell slightly short of the consensus analyst estimate of $1.23 per share. Even a small miss can cause short-term stock weakness by signaling a deviation from market expectations. Despite the miss, the underlying operational performance showed strong growth. Q3 2024 net income of $693 million was a significant improvement over last year. In Q3 2023, net income was $454 million. That year-over-year increase shows the core business is expanding and more profitable. Growth like this supports dividend sustainability and stock appreciation. Looking ahead, ONEOK provided guidance for expected full-year performance. For 2024, the company anticipates consolidated net income of approximately $3 billion. It also projects adjusted EBITDA of around $6.625 billion. The guidance includes expected contributions from recent strategic acquisitions. These numbers show management expects the growth trajectory to continue through year-end. For 2025, ONEOK expects total combined EBITDA to be comfortably above $8 billion. That would represent a doubling of EBITDA versus the pre-Magellan acquisition level 2 years ago. Achieving it would strengthen the company's financial position, more cash flow to support the dividend, pay down debt, and fuel further growth. Section 4. The business model. Pipelines, acquisitions, and growth strategy. ONEOK operates as a diversified midstream service provider. Its business is built around owning and operating the essential infrastructure that transports energy from where it is produced to where it is consumed. The company's main services fall into several categories: natural gas gathering, processing, storage, transportation of NGLs, fractionation of NGLs. Following recent acquisitions, it now operates in the refined products segment, crude oil segment. Its operations are concentrated in key U.S. energy basins: Visual, Mid-Continent, Visual, Permian, Visual, Rocky Mountain. A core part of ONEOK's recent strategy has been growth through major acquisitions. The company has made several large deals to expand its footprint and diversify its business. A key transaction was the acquisition of Magellan Midstream Partners. This deal expanded ONEOK's operations into the transportation of refined products. More recently, the company has added EnLink Midstream and announced the pending acquisition of Medallion. These deals are designed to open new avenues for deploying capital productively. By adding these assets, ONEOK increases its scale, broadens its geographic reach, and adds the types of products it handles. The company claims that these acquisitions are creating significant synergies. More than a year after completing the Magellan acquisition, ONEOK has stated that it continues to find cost-saving and revenue-generating opportunities that exceed its original expectations. The 2024 financial guidance already includes contributions from EnLink, which is now treated as a consolidated subsidiary for financial reporting purposes. The idea behind these deals is that a larger, more integrated system is more efficient and can offer more services to customers. This can lead to higher, more stable cash flows over the long term. This strategy of growth by acquisition is central to ONEOK's future. The company's guidance for 2025, which projects EBITDA to be above $8 billion, is heavily dependent on the successful integration of these new businesses. By combining different but related midstream assets, ONEOK aims to create a more resilient and powerful company. It can connect producers, refiners, and end users across a wider range of commodities and geographies. However, this strategy also comes with integration risk. The company must successfully merge different corporate cultures, operational systems, and customer contracts to realize the full potential of these deals. Section 5. Analyst perspectives, price targets, and future outlook. Wall Street analysts who cover ONEOK stock have a generally positive, though somewhat mixed, outlook. As of mid-November 2025, a survey of 14 analysts resulted in a buy consensus rating. 21% recommended a strong buy, 29% recommended a buy, 50% suggested hold. Notably, none of the analysts recommended selling the stock. Price targets from analysts provide a glimpse into expectations for future performance. One analysis of 31 Wall Street analysts found a median price target of $98.50. At the time of the analysis, this target implied a potential upside of 24.7%. Another source, based on 14 analysts, cited a slightly lower average price target of $92.71. These targets suggest room for the stock to appreciate over the next 12 months. The upside is likely based on expectations the company will hit earnings growth targets from recent acquisitions. Long-term forecasts show a very wide range of possibilities. This highlights the uncertainty in predicting market movements over many years. Some optimistic forecasts project a steady climb. One model predicts the stock will reach $85 by the end of 2025, $95 by the end of 2026, $150 by 2030, $200 by 2036. These bullish scenarios likely assume a favorable energy market and flawless execution of the company's growth strategy. These are not guarantees, but they represent a possible path if everything goes right for the company. In contrast, other forecasts are far more conservative and show potential volatility. For 2025, some predictions range to a low of $55.83 and a high of $68.61. For 2030, one source gives a low of $58.94 and a high of $114.89. This divergence shows there is no universal agreement on the stock's long-term trajectory. The future price will depend on many factors, including commodity prices, interest rates, and the company's success in integrating its acquisitions. This uncertainty is an important consideration for any long-term investor. Section 6. Key risks and final considerations. Investors considering ONEOK stock should carefully weigh the potential rewards against the inherent risks. One of the most discussed risks is the company's high dividend payout ratio. At 75.29%, the company returns a large portion of profits to shareholders. That leaves a smaller buffer to absorb a downturn in earnings. If energy markets weaken or cash flow falters, the dividend could come under pressure. A dividend cut is viewed very negatively and can trigger a big drop in the stock. ONEOK's business relies on the health of midstream energy markets. Many contracts are fee-based, providing some stability. Prolonged low commodity prices can cause producers to cut drilling and production. That reduces volumes through ONEOK's pipelines and plants, hurting revenue and cash flow. This commodity cycle exposure affects all midstream firms. ONEOK's aggressive acquisition strategy brings integration risk. Merging large companies is complex and costly. Magellan EnLink integration needs aligning technologies, business processes, and corporate cultures. The company expects synergies, but benefits may be delayed or not fully realized. Stumbles in integration can cause unexpected costs and operational disruption, disappointing investors. In conclusion, ONEOK is a compelling but complex investment. Income-oriented investors may be attracted to the high dividend yield. Investors who believe in the long-term growth from recent acquisitions may see upside if execution succeeds. More cautious investors may worry about the high payout ratio, reliance on commodity markets, and integration challenges. The stock is not for everyone. It requires belief in management's vision and tolerance for the cyclical energy industry.